Hi everyone and welcome. It's Steve Johnson here, Chief Investment Officer at Forager Funds. It's a Friday afternoon here in lockdown Sydney, and I'm joined by Portfolio Manager on our international fund, Gareth Brown. We're going to talk some stocks. Hi Gareth, how are you?
Hey mate, hi everyone.
We've also taken the reins from the marketing team. I'm not even sure if this video is going to get through, but we're adding a Scotch whisky appreciation element to our Friday afternoon video today. Gareth, you and I have worked together for 20 years. We've shared a couple of nice scotches over that period of time. I know you like a good one. What have you brought along today?
I've been a member of the Scotch Malt Whisky Society for about better part of a decade. This group, they've been in existence for 30 or 40 years, I think, and they go around to the Highland distilleries and the different distilleries around Scotland. And they try a whole bunch of stuff, and then they buy a single barrel and they turn it into 500 bottle releases and sell it to members around the world. And I've been a member for a few years. They've got a great little tasting room in London. I'm there twice a year, so I find an excuse to go and try a few whiskies and bring a bottle home. And it's typically cheaper over there than it is here. This one here I actually bought in Australia. It's from distillery number 1, which is Glenfarclas, which is a distillery also in Speyside. And this is a single barrel whiskey that's called Dessert Triptych Mushroom Sorbet. It's a very tasty whiskey. It's maybe a little less crazy than the naming rights. It's only 10 years old. It's not a particularly old one. It was barreled in 2008. And it comes from an Oloroso butt. So that means they've used the cask to make sherry in the past, and then the whiskey buyers have bought that barrel, and that's where the barrel is aged from 2008 to 2018. And then sometime later, it ended up in my possession, and it's 3/4 gone. So
very, very nice. Well, you pour yourself one of those. I've gone a little bit more mainstream, brought along a Balvenie Doublewood. Also a Speyside whiskey. Anyone who's trying to get into their whiskies for the first time, the Speysides are generally a really smooth whiskey, not a lot of peaty taste to them at all. It's in the north of Scotland on the Spey River, sort of a bit west of Aberdeen. Did you come with me on that trip to Aberdeen all those years ago?
I have been to Aberdeen a couple of times, yeah. It's sort of between Aberdeen and Inverness where we're talking about here.
Yeah, it's a dreary city, that one. If you're in a grey, cold climate, I don't understand why you make all your buildings grey as well. But anyway, this is a really easy drinking whiskey. This is a 12-year bottle, about $100 in most bottle shops. They've got a 17 and a 25-year one as well, if you're making a lot more money on the stock market than me. So there are our whiskies for today. I'd say 2 pretty easy drinking ones, it's fair to say, Gareth.
Yeah, exactly. So let's get into the stock chat. I've just edited your CIO letter for the September quarterly. I thought it was a really interesting letter here, a lot of analogies around the game of chess. Maybe you could give a quick insight to people who haven't yet had a chance to read it.
Yeah, I mean, I played some chess in my early 20s. I had a flatmate that I lived with down in Bondi that used to like going up to Gertrude and Alice bookshop and sitting there and having a few games of chess, and he used to wallop me all of the time. So I got a bit interested back then, and then lived on my own for quite a few years and read a few books, and it got a bit better, but I'm certainly not a dramatically good player, but really haven't played for most of the past 20 years. And like a lot of other people, I think, the Queen's Gambit on Netflix and then being locked down in my house for an extended period of time, I got back into playing a bit of chess on the computer and reopened my chess.com account. And it's just changed dramatically over the past 20 years. It's so much fun on the computer. The tools for learning are pretty extraordinary. And yeah, I've really, really enjoyed it. I'd say the basic principles haven't changed a lot, but the tools that you have in something like chess.com for the rest of the game are really, really useful. You can literally sit there and play a game against a computer and have it tell you after every move what you've done wrong or right. If you want to borrow some suggestions when you're not sure what to do, you can do that. And you can go back and analyze games that you've played against other people as well, and get a whole heap of tips about how you might want to play better.
You split your letter into the opening game, the mid game, and end game, I guess. And I thought even the opening game stuff had some useful investing analogies. Let's not be too torturous around analogy, but you can learn some useful lessons here. Get in there, control the center, and put those pieces to work. And I think even that's useful analogy for investors here. Start young, save money, buy real assets, try not to suffer any catastrophic loss at the beginning, and then you've got time on your side.
Yeah, I think we're going to get into some, I guess, portfolio management conversation today, which is a bit more complicated, but I do think people forget those basic principles too often, and you should never forget them when you start thinking about other things. I think the other things are additions and complements to those basic principles about just getting your wealth invested in real assets. I've seen more people lose money from fear of the next crash than I've ever seen make money out of the crashes when they come along. So I think don't forget that, and that is the similarity with getting those big pieces out there in the chessboard and making sure that you've got your important pieces working, even though that comes with risk that they might get taken at some point in time.
So the next part of the story here is that you've compared, I guess, the current market environment to the mid-game section of the chess game. And I think that's interesting because you were saying it's the area you've sort of learnt the most around chess in the last little bit with your AI enabled teachings,
Yeah, that's absolutely right. Because I mean, you can buy a few books off the bookshelf. I've got a Bobby Fischer teacher's chess book here, and those basic principles about opening games, and there's probably only 10 that you're going to come across in most games of chess that you play, and they can run through all of them and say, here are the things that you want to do and the things that you want to be careful of in those 10 different variants of opening games. And likewise, I think the key ways of taking pieces, there's nothing different now from what there was 50 years ago. There's some tricks and tools that you want to use if you want to take other people's pieces. But I really got to the point with my chess where I was getting through that opening game fairly untroubled most of the time, and then my pieces are in the right place and my opponent's pieces are in the right place, and I'm sitting there saying, well, what's next? And my natural inclination was to attack. Exactly. I'm sitting there thinking, well, what am I going to do now? And this is the time when Beth Harmon from the Queen's Gambit's sitting there dreaming up these amazing attacking maneuvers and shocking the opponent. And too often I just did that. I was aggressive in my play, and you sit there with the computer recommended moves, and sometimes it's, just move this innocuous pawn piece one square forward, or take this piece that I thought was in quite a good position and move it backwards. And I honestly don't know that I'd ever moved a chess piece backwards in that middle part of the game in my life. And it really opened my eyes to a bit more patient chess play. I think that there's a whole middle part of the game where you don't need to win it in that move, that you want to sit there and wait for your opponent sometimes to give you the opportunities to do things that are aggressive down the track, and setting yourself up to make those aggressive moves is the important part of it, rather than necessarily just attacking straight away.
I don't want to mix sporting metaphors too much here, but it sort of reminds me of that concept in tennis that, at least at amateur level, that it's a loser's game, that that mid part of chess, it sounds like it's similar. Just don't screw up too badly too.
And look, it can be, and I'm sure great players can attack very early on, and sometimes it's right to attack very early on, but there's certain games and certain types of players and certain environments in which that is not going to be the right strategy. And
then in the letter, you've drawn that analogy with some of our moves in the fund, in both funds really, over the last little bit. There are some new-ish defensive stocks in the portfolio. We talk about Tesco in the letter. This is a business we've owned in the past. We managed to lose money on it. Tesco's had a lot of troubles in the past and faced a lot of competition. They've really turned that ship around. They're focused really on their core business, which is the UK. They have taken it to the Aldis and Lidls of the world, and they are winning market share again. And they have higher market share in the online world than they do in the direct grocery world. Available at 13 times current year's earnings. It's pretty easy to see like an 8 to 10% annual return over the next, let's say, 5 years, which, might not sound super exciting, but could be a very valuable defensive return if the growth stocks and the concept stocks keep going off the boil, which is it's where the market's heading at the moment.
Yeah, and I think really importantly, when we think about it occupying an important square, it's something that we can convert into, 15 and 20% returning opportunities when those come along. I think because it's going to prove fairly resilient, you would think, in a difficult market. And I actually think this one, you look at the multiple here versus a Woolies here in Australia or a lot of other defensive businesses around the world. I think there's a decent chance that we make good money in the relatively short term out of it as well.
Right.
Just
if it moves to if people decide that it's now, a defensive cash flow and interest rates are still low, then maybe 18 is the right multiple, not 13. And we make better than 8 to 10% returns.
Great. Yeah, and I think we've talked a bit about it, but Downer EDI has played a similar role in our Aussie fund. We've recently added Seven Group. We own Seven West as well, but Seven Group, which owns a Westtrack business over in WA and a collection of different businesses that we think can play a similar role there. And look, I think for me, from a stock market perspective, I think been much better at this middle game historically. But when I look back at that early years of Forager or intelligent investor funds as it was then, I think that desire to be aggressive and aggressively contrarian all of the time led us to some missteps. And I'm really adamant that we're not going to make those same mistakes this time around, that there's a time and a place for those aggressive moves. And, I just don't think this market is one of those at the moment.
Yeah, maybe going a bit off script here, but you arrive at that conclusion organically from doing a lot of research bottom up. So it's just getting a little bit harder with some of these growth stocks to make the numbers work, and they're not the laydowns that we were seeing 12 months ago.
I think that's right. Yep.
I think there's some sort of bigger picture issues there, as well as the market's obviously had some wobbles. I think there are really two quite large related issues here, which is inflation, which is back on everyone's lips again, and also interest rates, which is a related thing. We've had this paradigm for the last 40 years of falling rates, and yet inflation hasn't turned up. And to the extent that continues, great, we're going to have these ultra low interest rates for a while, but there are some signs emerging that are a bit concerning on the inflationary front, and that the central bankers may have to change their script from recent history of just constantly cutting rates and supporting markets, but rather to actually be focusing on the real economy. So the thing that's got me interested at the moment is the entry-level wage in the US, globally really, but in the US, we're hearing of shortages in Australia, same in the UK. Some of it is somehow influenced by COVID, so I'm not pretending it's necessarily a long-standing story, but I read a piece of research from Bank of America a little while ago that I thought was quite interesting, because we've had this paradigm for 40 years that the entry-level wage in the US in particular has just been flat in real terms, but also pretty flat in nominal terms. And these people have effectively taken pay cuts for 40 years. And the assumption is that is not only going to continue, but it's been the recent past. And the whole piece sort of made you call that into question. So I've just got to pick the numbers up here, but the entry-level hourly wage in the US doubled 2010 to 2020. As it's a 5% compound annual growth rate. Their expectation is that continues out to 2025. So we are talking 5% increase in wage, whereas we're all living in this paradigm saying that low-end wages are flat, and they haven't been for a decade or a better part of a decade.
You remember what a furor it was when it was $7.50 the minimum wage, I remember, in the US, and Obama was trying to raise that nationally, and it was such a furor. And you've got Amazon out there now saying their average entry-level wage is $18 an hour.
18. And B of A got at this at $25 an hour by 2025. So that just gives you some sort of idea. So you've got 5% nominal growth in wages. Does that sound like a world to you where 1.5% is the right yield on a 10-year bond? And the market's sort of coming to this conclusion at the same time as us, I think.
Yeah, I think that's right. And it's the difficult question. I think some of those demographic issues that have been laid out as contributors to low inflation over such a long period of time, they haven't gone away, right? Aging populations and the glut of savings and the impact of technology on the cost of doing things. But, you know, if that paradigm is ever going to be tested, it feels like this is the time. And it's not just inflation, that the world is in a really, well, the world economy is in a really precarious position as it tries to deal with the surge in demand coming out of COVID, and we're seeing that pop up all over the place. I just share this quickly.
Everywhere, isn't it?
Got a slide here. That's the number of container ships that are parked off Los Angeles and Long Beach in the US. It's typically nothing, right? You take the container ship in, you unload it, you turn around and you go back out. Currently 70 something container ships anchored off the beach. That's just the anchored ones. I think there's more than 140 or something in the area at the moment, and you see some pretty crazy pictures of all of these things trying to get around like a car parking lot and maneuver to get in. So that's crazy. And then there's a little paragraph in the Economist a couple of weeks ago, headline: "A foul situation. One of the many knock-on effects of the turmoil in gas markets was a shortage of carbon dioxide as an industrial gas in Britain. A big producer of carbon dioxide had to close its factories because of soaring natural gas prices, which in turn led to warnings from the chicken industry about a possible paucity of poultry. Carbon dioxide is used to stun hens for slaughter." So I think there's all these impacts that, I don't even know that it would have been possible to work out the linkages between them, but we are seeing it in the companies that
carbon dioxide too.
We're seeing it turn up in the, yeah, exactly. We're seeing it turn up in all sorts of weird and wonderful places with almost all of the companies that we talk to. And
I'm sure most people have heard about this, but the automotive one is fascinating. So there's a shortage of computer chips, and it's really having an impact on the global automotive market at the moment. So we're having probably something like 5+ million cars that there's the demand for that are not being built this year because they can't come up with enough computer chips to build them, and it's having impacts on prices. It's having massive impacts on the secondary market because people are having to keep their cars longer, and used car prices are up around, recently used car prices are getting up around new car prices. And if you can get your hands on a new car, it's just a strange world that we've not experienced. Certainly in my adult life, I've never seen anything like it. Maybe the 70s is the right analogy there.
Yeah, and I think the other thing out of all of this is 40 or 50 years of corporate profit increasing their share of GDP over time. And you've already talked about labor as being the main loser in that equation, and increasing signs that trend may have turned as well. I talked a lot about multiples we don't have it on the agenda to talk about today, but market multiples in my letter today. I think as a risk, it's worth thinking about whether the earnings themselves are at risk from all of these disruptions as much as the multiple itself as well. So look, I think these are really, I guess we can sit here and talk about the risks, and then you could say, well, why aren't you having an aggressive bet on some of these things? And I just think they are really, really complicated problems. I think when it comes to investing, we're trying to think about them in terms of impact on the downside, but actually sitting here today and saying this is what the world is going to look like in 5 or 10 years' time is as hard as it has ever been. And my view is we're going to have much simpler problems to solve than that down the track. So it's not that there are not problems out there, and I'm sure there's money to be made on both sides of those equations, but I think they're very difficult problems to solve.
I think that, this is not our purview, right? We try to find the exception where we think we can understand a stock better than the market, and that we got the odds in our favor and we buy it. But we are responding to what's happening in the market. It is getting harder to find some, opportunities we're particularly comfortable with. You look around and here's the background against all that, which I think is interesting. You've talked here about the response to that, so it's a bit more cash, which is what we've trended in both funds over the last little bit, a little bit more Tesco-like defensive businesses, and on average smaller weightings to the growthier, potentially riskier end of the portfolio. Can you talk about that last point a bit?
You could look at the 3 months we've had in the international fund of, I think it's cumulative down 8 or 9% or something over that 3 month period, and say we should have been even smaller than we were in terms of our weightings to some of those stocks. And most of the damage has come in the businesses that did sensationally well for us last year. And
I mean, we sold really, really hard in April, May, June. I agree, you're right, but we've got to be careful with that hindsight filter.
No, of course. And look, the magnitude of some of the falls in this small cap space, it sort of has me on the precipice of wanting to make one of those, or some of those more aggressive moves, or at least start moving in that direction, because some businesses that we really like here and that are performing very well have come back to far, far more reasonable levels. But I think the general principle about our weightings across, and this is true of both portfolios today, we've got lots of 2 and 3% weightings in our portfolios, and you should expect to see us have 5s, 6s and more in the right opportunities over time. And the reason that they're low is because we know that these types of stocks get very, very cheap in dysfunctional markets. And we like the businesses, and we think the medium to longer term returns from them are going to be good from these levels, but we want to reserve those big bazookas for the dramatic opportunities that we know come along from time to time. It won't be in all of the stocks that we own, but there'll be opportunities in there to really upsize some of those weightings.
Yeah, for sure.
It hasn't been as easy though, Gareth, just in terms of, especially in your part of the world, around adjusting some of the weightings here as you see fit. Liquidity issue that we've been noting to some extent for a number of years across a lot of your stocks and the part of the world that you cover, just seems to be getting worse and worse.
Well, I've been trying to balance that out it's been 6 months now, where just looking for more traditional value stocks or things that can grow, but the price it's not recognized in the price. Like, I guess deeper value than we sort of been doing really well out of the prior 6 months. Motorpoint's a great example here. The liquidity issues in Europe are they're getting worse. So Motorpoint is a used car dealer. They're a really well managed operation. They're doing very well. They've announced some strategic plans where they're going to double sales over the next 3 or 4 years. I'm confident in this as a long-term investment. It's one of our larger positions. They came out with a trading update yesterday, which was very positive. Outlining their first half sales up 57% on last year, which was a COVID year, and sort of up 15% on the year before. Profitability's up. Everything's looking good on this 3-year plan that if they deliver on it, we're going to make money. They announced a trading update, which is usually when you get spikes in trading. No such spike. We had 30,000 shares trade yesterday, less than 100,000 pounds worth of shares trade on the whole day in maybe 24 trades in total. And this is a $300 million company, plenty of free float. If this was listed in the US, it'd trade 50 times as much, I would guess.
Yeah, it's 300 million pounds. So like 420 or something US million dollars. And if I compare that with, a Fathom, another small cap in our portfolio, which is listed in the US, that company's 370 million market cap, half of which is owned by the founding family. So it's a free float of something like 180. It traded 800,000 to $1 million yesterday, which is still pretty illiquid by our standards. Yeah. But that was a day with no news.
Day, it'd be 5 times that. And
yeah, exactly right. I don't have a clear explanation. I think it's largely an institutional market in the UK and Europe. There's not a lot of retail trading goes on, and it just seems to be getting worse.
Some of the regulatory changes over the years have really impacted it. MiFID 2, it's not worth getting into, but basically a lot of support from broker community for small caps has gone out the door. Research has gone out the door. So there is some potential explanations here, but looking at it from our point of view, it's a risk and a bit of a pain, but it's also partly where the opportunities lie for us. So you can see why American investors in particular look at Europe and go, I can't buy a 300 million pound company because it just doesn't trade enough. Those liquidity issues have definitely gotten worse over the last 5 years. It's also the advantage if you're prepared to work with it. We accept liquidity when we think there's a high probability that the stock is going to keep growing and do well over 5 years. We want to have that higher bar for illiquid stocks. And we're getting paid for taking on that illiquidity. So, it's the pain and it's the opportunity.
Yeah, and I think the other implication is just less fiddling around at the edges, right? I think you sell a stock like a Motor Point on a day like yesterday, and you might never get that stock back if you want to increase the weighting at some point down the track. So where we might be a bit more opportunistic around on a fathom in terms of trying to take money off the table and put it back on at different share prices, I think with some of these UK stocks where we really like the long-term runway, we're just going to leave it and let it work its magic internally over a long period of time.
Yeah, you've really got to stick to your guns though. Like you buy a similar company in the US, you have a thesis, the earnings come in, the share price pops, you tick, I've done my job. Here you're like, the market's just got their attention elsewhere. I think they're the ones missing something, not us. I could be wrong, but it's just a less satisfying way to go through life. But then that's where you get the cheaper stocks. So, that's what we get paid for.
Yeah, those signals are difficult, right? The share price ended up closing down yesterday of Motor Point, and I think the last trade was 10,000 shares or something at that price. It doesn't really tell you anything about whether the trading update was taken positively or negatively. Well, we might wrap it up there, G. Cheers for Friday afternoon. Let us know what you thought of the format. We'd be more than happy to review a few more whiskies on a Friday afternoon around our monthly and quarterly reports.
Or if you prefer wine, just let us know. We can work that in as well.
Multi-talented and diversified portfolios. Thanks a lot for tuning in, and we'll be back later on. Thank you.